And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Second best day of the week, of course, Thursday, as we get ready to wrap up the week. Interesting news out this morning, gentlemen and ladies, if you're watching the show right now. This Saturday is Husband Appreciation Day. So
we have one of those?
We have one of those. Apparently Saturday, Husband Appreciation. So, you know, wives, appreciate your husband for the little things that he does and gets right every now and then. Like if he remembers where he put something, appreciate that. So, yes, but we have Husband Appreciation. I did swing by the Hallmark store. Yeah. Nothing there.
There's not a tent in the Kroger parking lot?
No tents in the Kroger parking lots. No Husband Appreciation cards are out on the shelves. But apparently Saturday is Husband Appreciation Day. So
Hallmark's not getting with the program.
There's no money in it.
No demand.
No demand for Husband Appreciation cards. Do you know that Father's Day is like the 17th most celebrated holiday? It's like Arbor Day is celebrated more than Father's Day. Right. I'm just saying. So yeah. Hey, by the way, speaking of, Mother's Day is coming up right around the corner as well. So now that's the one you don't want to forget.
Boy, howdy.
Saw TikTok this morning. Yeah. Mom, if you're the mother of a dog, you apparently need appreciation on Mother's Day because apparently dog moms qualify.
Oh, that's a thing.
That's a thing.
Yeah, baby.
So there you go. Mother's Day right around the corner. May the 12th. Ask me how I know that because it's my birthday. I was a little gift to my mother on Mother's Day.
Surprise.
So, exactly. Yeah, she's never forgiven me since. Anyway, okay, a couple of things out this morning. So tensions in the Middle East finally starting to calm down here a bit, as we kind of talked about last week as well. Cooler heads were always likely to prevail. And again, it's always very interesting that when, these headlines rattle off, somebody shoots something at somebody else, it's immediately World War III. And so everybody kind of goes into revulsion over, the end of the world as we know it. And again, as is normally always the case, now we've had a few world wars. I'm not going to deny that, right? But generally, more often than not, cooler heads tend to prevail and these things calm down. And that's kind of what's happening. Starting yesterday, as well as today we're starting to see oil prices come down a bit. Things are starting to kind of cool off from that recent kind of upsurge in tension. So again, this is why we're always, kind of cautioning against, these headlines and headline risk. Because immediately, if you go to websites that typically lean very bearish, the ones I'm talking about, immediately, like top pin posts, World War III right around the corner. That type of stuff kind of leads you to make bad investment decisions over time. And again, it may appear fine in the short term, but in the long term, these things tend not to really work out that way. So just, as always, just be careful of the headline risk, because that's generally kind of what gets you in trouble from an investing perspective. So, that's that. We've had several Fed speakers out. Jerome Powell out yesterday, actually talking about the fact that, inflation is being a little bit stickier than expectation. But while there's been quite a few headlines, UBS out just recently talking about how the Fed's going to hike rates to 6.5% from 5.5%. Jerome Powell did not make any inclination of that. In fact, his specific words were that policy rate is tight enough right now. They just need the time to allow tighter policy to work its way through the system. So they're still dealing with that lag effect of a lot of fiscal spending, a lot of monetary spending still in the system. We've talked about the M2 money supply. That's still very heavily integrated into the economy right now. A lot of spending going on. That Inflation Reduction Act, the CHIPS Act, we're awarding billions of dollars to companies like Intel, Taiwan Semiconductor to build plants in Arizona as an example. So again, that's going to impact the economy. That's going to create this economic growth that is helping keep inflation a bit sticky right now. But policy rate is fairly tight, and we're likely going to see slower rates of inflation as we get into later this year. In the beginning of next year. In fact, we've got some data coming out of that in this weekend's newsletter as well. So be sure and get by the website and get subscribed to the newsletter if you haven't done so already. Just a link on the front page. Just subscribe. We'll email it to you on Saturday. Okay, outside of that, here's what you need to know before the bell this morning, because markets are still in a correction mode. We kind of ad nauseum in January, February, talking about a potential for a correction. This market was just kind of grinding higher along this 20-day moving average. And we suggested that, hey, watch that 20-day moving average. If we break it, that's going to flip all these computer algorithms that were buying the 20-day moving average. Every time we touch the 20-day moving average, computers would come in and start buying the dip, right? And we said that when we broke that 20-day, that we were going to flip those algorithms over, and now it's a sell the rip rally. So every time the market tries to rally, and again, we're going to try that again this morning, the markets wind up getting sold into. And so we've had a fairly decent decline here. We're down about 4%-ish. 4.5% from the peak. So we're working towards that initial 5% correction. We're sitting, looking at kind of from a technical perspective, there's what's called Fibonacci retracements. Don't get too worried about it. If you want to go Google it, you can. But it's just basically a series of retracements set up on mathematical ratios. It's called the golden ratio. And that first ratio is a 23.6% decline from this peak. So in other words, if you take a look at this bottom and look at that top, the first decline would be a 23.6% decline of that entire rally. So we're approaching that right now. So we're in fact, yesterday we actually touched that. So the market's kind of bounced off that support level yesterday, and we're set to have a bit of a rally. Now we've had 4 straight days of selling. Markets are getting oversold here, so this is getting pretty deep oversold. Generally, this is where you're going to get a bounce. Now, the question is it a bounce that you want to buy, or is this a bounce you sell into? Too soon to tell for that, but again, we're at a point this market is going to bounce, and what we're looking for now, when this market bounces, when you get this rally, if this rally's really been weighing on you, right? You've got positions that are really weighing on you and you're really kind of stressing out over this, use any rally back towards 5,100. That's about where the 50-day moving average is, to lighten up positions. So sell what you need to sell. Now, what you're looking for here ultimately is for this MACD indicator to turn back to a positive buy signal. As long as we're on a sell, that's going to suggest that we've got lower prices, or at least a consolidation of prices. So again, just use rallies here temporarily to sell into, rebalance your risk. As we talked about yesterday, a lot of stocks have already had very big declines, and you're like, oh, I missed that stock. I've been wanting to get into it. It's had a big decline. It's oversold. It's sitting on support, whatever it is. You can start nibbling into those positions, sell positions you need to sell to reduce risk in your overall portfolio. But again, as we start to see this MACD signal here turn back to a positive buy, that'll be the point after this correction to go ahead and increase equity exposure back to target weight. So again, this is just a normal, healthy correction within a bullish trend. We've got no evidence right now of a bigger market correction, 20% type correction coming. Doesn't mean that can't happen, but we really don't have any of the economic data, earnings data, et cetera, that is certainly supporting that. So again, this is just a normal, healthy 5 to a 10% correction here, probably in the 5 to 7% range. Could be 10, that'd take us down to the 200-day moving average. But probably somewhere between where we are now and this 100-day moving average is probably going to be about the depth of this decline. And then this market's going to try to rally into summer. So now once we get into summer, another correction is probably coming, but I would expect to see a bit of a rally here in the next few days, potentially even starting today as we get further into earnings season, and particularly if earnings are supportive of that. So we'll talk more about that. Michael Leibowitz joining me today. We've got a lot of stuff to get into, interest rates, inflation, the Fed, as usual, as we do on Thursdays. We'll get to all of that coming up right after the break here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So it is Thursday, as I said. Michael Leibowitz joining us this morning. Got a few things to get into, of course. Jerome Powell out, as I said yesterday, talking about, kind of Fed policy, where interest rates are going. And again, there's been a good bit of teeth gnashing here over the last week or so. Interest rates have gone up as inflation ticked up a bit higher than expected in terms of CPI. And this is, it kind of got the whole kind of markets on edge. And, UBS comes out, talks about, the Fed's got to hike rates now to, 6.5% in order to kind of beat the inflation monster. But Jerome Powell was pretty clear yesterday in his press conference that specifically policy is tight enough here. I mean, there's no hint that the Fed is even thinking about at this point that they're going to hike rates further. Again, they're still kind of focused on, and commentary remains that they're going to cut rates, but it's just a function of time. And they want to see a little bit more progress on inflation coming down as they start to cut rates. So again, that was just kind of the conversation yesterday. Bond market had a big rally. 20-year bond auction had just a massive amount of demand yesterday. So Mike, what was your kind of takeaway from Jerome Powell's, kind of talk and the bond market action yesterday?
Yeah, he was slightly more hawkish, I guess, but he's kind of parroting what everyone else has been saying. Mm-hmm. Basically, they're not going to cut rates till much later in the year. And I guess he's starting to raise the specter that they may not cut this year. But he also makes it pretty clear the next move is going to be a cut. They don't even go anywhere near raising rates, like you said. Yep. So, not surprising. Fed funds futures are pricing in, less than 2 at this point. Every Fed speaker is saying 2. So in some ways, this is healthy, because they continue to maintain very, very conservative policy here, restrictive policy. And that should and will continue to take a bite out of inflation. And they're not letting inflation fester again by lowering rates and creating more demand. So I think that's a positive. And I think it's also positive that the market and the Fed are on the same page. Typically, markets run into problems when they have a very different opinion than the Fed, and the Fed doesn't acquiesce to the market side. But, over the last, 3 or 4 months, we've gone down from 7 rate cuts to 2 or so, and it's been pretty much orderly. Yeah. The last week or 2 has been a little sloppy on the downside, but we became very overbought at 2. So I think the markets, both stocks and bonds, are in a healthy place right now. And, we're just going to continue to keep an eye on inflation data. Like you said, Lance, the bond market, we're always talking about these auctions, which we never talked about before, because they're a one-time, they give you a little window into supply and demand at one time. And they're not great indicators. If you want to look at how the auctions are doing over long periods, I think that's okay. But they're really just showing you what's going on at any, relatively short one period of time. Yesterday's 20-year auction was very good. The auction came in at over 3 basis points, better than where it was trading right before the auction. So that means that Wall Street bid it up. And actually, Wall Street didn't bid it up. It was everyone else. So Wall Street's share of the auction was the second lowest in a long time. Yeah.
Foreign buyers foreign buyers have been very strong buyers of bonds as well. There was
foreign buyers.
There was a very interesting chart out by Bank of America this morning. Over the last couple of years, foreign buyers have been very strong buyers of treasuries and continue to be, because again, housing reserves. We've talked about all this before. So, but they had a very big participation in that auction yesterday.
Right, and retail and institutional are buying as yields get back to 5% or closer to 5%. I feel like some of them may have missed the opportunity the last time, so now it's a second chance to kind of lock in close to 5% yields for long periods of time. So as yields tick up, they become more attractive and create their own demand. And I think that's what we saw. But last week we saw some pretty bad 10 and 30-year auctions. So, but again, it's a window into the environment. That it's a very short window. Yeah. So both good and bad auctions.
Yeah, but Mike, I've pulled that auction data, and it gives you really no indication. It's just a line that just jumps up and down every week. So I mean, like 1 week have a bad week, next week is good, next week is bad, next week is good. I mean, even if you I've tried to smooth the data, I've tried to put it on stochastics. It's just there's just no indication there of what is going to be the auction from 1 week to the next. There's not a trend to the data like, every auction's bad over a period of time. It's just kind of useless. I don't know why we pay so much attention, or lately, as you said, have started paying so much attention to these auctions, because they really don't mean anything.
No, and really what they're kind of a gauge on is Wall Street banks are expected to make sure the auctions go fine. that means that every bond is accounted for. So starting a few days before the auction, they're trading in what they call the when issued market, and that's the bond before it's settled. And they're trying to gauge customer interest. And if they think customer interest is going to be strong, they take actions in the WI market. And if they think it's going to be weak, they take other actions. And their goal is to really make a little money, but make sure the supply and demand meet. And when they meet, you have a average auction. But when Wall Street misjudges the demand, like they did yesterday, that's where you can get, a very good auction. And if they misjudge it if they misjudge it and there's weak demand, you get bad auctions. But again, it's the demand, the supply and demand for a given couple days, not long periods of time.
Right. And that's why, again, it's just, these things, whenever there's kind of a narrative running around, it's everybody kind of latches on to, one piece of news to kind of prove a point. And generally there's, not a big correlation between those. And as I was saying at the open, over the last week, it's been World War III. And we've been saying that, look, the cooler heads are going to prevail. This will pass. It doesn't mean things can erupt into World War III. I mean, we did have 1 and 2, right? But, we've kind of learned lessons from the devastation of that. And so people really don't, even government officials don't really want World War III. It's okay to kind of puff out your chests and, rattle your sabers, but nobody really wants to get there. And, so again, these things, they make great for headlines, and it causes a lot of turbulence in the markets. It causes investors to make mistakes with their portfolio, and then these things calm down and things reverse. But, this is, kind of, the problem with the markets in general is that we're so narrative driven. And as I was explaining, at the beginning of the show, we have so much of this market driven by algorithms now. It's either programmatic trading, computerized trading algorithms, something. So much of this is driven by these computer programs that breaks of support, headlines, etc., just add a whole lot of volatility to the market.
Yeah, I think the narratives, because of technology, have gotten a lot more powerful and a lot quicker to spread. Back when we were starting out, narratives took a long time to form because people had to call people who called people. It showed up in the newspaper.
3 days later.
It just took a long it took a long time to spread. Now these narratives are just instantaneous.
Yeah.
And I think the narratives, because there's so many and they can grow so fast, they're potentially less correct, right? There's a lot of false narratives that do drive markets, and we have to pay attention to it, and we have to appreciate that our view may be different than the narrative, but the narrative is in the driver's seat.
There you go. We lost you for a second, but yeah, so narratives are in the driver's seat. But yeah, so, and so kind of going to, kind of full circle here, going back to, the Federal Reserve, the big concern here lately has been, a pickup in inflation and, where's inflation headed to kind of next. And this has really been what's driving the markets. We've had 4 months in a row now where inflation's been hotter than expected. Retail sales were strong. So obviously a lot of reasons concern about higher rates of inflation. And that's, of course, driving a lot of the, kind of some of the narrative in the bond market as well. But from the Fed's concerned, it doesn't seem that they seem to be too concerned about this. And so, when we come back from the break here, maybe we can kind of get into some of the data around the inflation numbers that have come out, some of the data, some of the work that you're doing right now that we'll have in tomorrow's commentary. And by the way, in the chat right now is a bunch of commentary on Bitcoin and Bitcoin halving, which is actually in today's commentary on the website. Mike was writing about this morning. So if you go to the website, realinvestmentadvice.com, and click on our daily commentary for today, there's some information in there about Bitcoin halving, which is coming up this weekend, Mike, on Saturday?
April 20th.
April 20th. So there you go.
My birthday.
Oh, really? Happy birthday.
Yep. Thank you.
So everybody's got birthdays coming up.
That's why they're having it.
By the way, your birthday's on Father Appreciation Day, Husband Appreciation Day. So you get a double,
so maybe
a double
between
benefit.
the two, I'll get some appreciation.
You get a cake. and you'll like it.
If I'm lucky.
If you're lucky, exactly. All right, quick break. We'll come back. We will talk a little bit about inflation coming up after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You've heard about this quiet quitting where, I'm just not being paid enough to do my job, so I'm just going to not really do my job. They now have a thing called the Bare Minimum Monday.
The Real Investment Show podcast.
Basically just doing the bare minimum on Mondays just to get your paycheck and go home. Ultimately, the people who run the business go, well, if you're going to do the bare minimum, I'm going to do the bare minimum and not need you anymore.
At realinvestmentadvice.com.
At some point, somebody's got to work. That's kind of the way it works.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I had to chuckle to myself this morning because I read an article that Gen Z is rediscovering things, and this has got to be the most unoriginal generation ever. All we do is remake 80s movies. They just slaughtered Roadhouse. So Just stop. And they've got another one coming out here. The Fall Guy. They're doing a remake of that one. Stop messing with the 80s movies. They were good. Leave them alone because y'all don't do a good job of remaking them. Just stop. Go make some new stuff, right? Stop remaking 80s movies. But Gen Z is now rediscovering things like, we talked about this recently, quiet walking, right? They want, which is going outside to walk without your earbuds in. Just, listen to nature and kind of disconnect from things. They're also rediscovering the public library. So, going to the library to actually read a book rather than, reading it on your phone. Going outside is a whole new thing now. Apparently, actually going outside to play, sending your kids outside to play. And, this is when I was growing up, we weren't told to go outside. We were forced outside. The parents locked the door and said, don't come home until the street lights come on. Get out, right? And if you get thirsty, there's the water hose, right? And so in the summer, you were drinking 180-degree water out of a water hose. Surprised we all didn't die of lead poisoning, but there you go. They're also discovering flip phones.
Really?
I think that's because they can't afford a smartphone. So I think they're going back to the flip phones.
Yeah.
Handheld camcorders are now coming back. Yoga pants with the bell bottoms. They're coming back into fashion. There's some things that you really don't need to rediscover at all. And if you really want to feel old, Brent, they're rediscovering the nostalgia of 90s music.
Oh, really?
90s. They're going all the way back to the 90s for the oldies but goodies, right?
Yeah, I've got one piece of advice.
Yeah.
Stay away from the 80s.
Oh, man, 80s were the best.
No.
Yes, 80s were the best.
Disco sucks.
No, but you also had hair bands in the 80s, right? You had Kiss, you had Boston, you've had so many others.
Night Ranger,
yeah, Foreigner,
right. Yep.
Kansas,
AC/DC.
Who else?
Metallica,
Van Halen.
Oh, yeah.
So you just don't write off AC/DC. I mean, they're still using AC/DC music in movies. So, come on.
I stand corrected.
There you go.
All
now, the disco, I agree.
Yeah.
Yeah, disco, I agree. But there's the hair bands of the 80s. Yeah. Maybe y'all should not rediscover those. Leave those for us.
Mm-hmm.
Pat
Benatar.
There you go. Heart. Fleetwood Mac.
Mm-hmm. Yep. The good
and
stuff.
There's people on our YouTube channel right now going, what? Who is this?
Poison. Motley Crue.
Rat.
Round and Round.
Yep. Mike, you've got no contributions here?
You know what? As I get older, I kind of like the disco stuff. So I'm a little disappointed in you guys.
Okay, well.
But 90s, isn't 90s more grunge rock?
Yeah. It was where it was starting to kind of lose its.
Kurt Cobain.
If you want real music, though, you got to go back to the 60s and 70s.
Yeah. Nickelback was in the 90s.
Nickelback. Good grief.
Well, Mike's still trying to find his gender, so that explains the disco problem. Anyway, all right, let's get back to work. See, this is what happens on break. I scroll headlines, so that's never a good thing. Anyway, so Mike, talk a little bit about inflation. You're doing a little bit of work for tomorrow's commentary on inflation. This has, of course, been the big concern as of late, that inflation is roaring back. We've had a couple of months, 3-4 months now, where inflation's coming a little bit hotter than expected. It's not really surprising that we see an uptick in activity after a downtick in activity. We saw that, if you go back and look at retail sales as a good example. In October, November, December, we had very weak retail sales relative to expectations in particular, as the consumer really kind of retrenched. And of course, those 3 months in particular are very big shopping periods. So, that's October, that's Halloween, and you've got Thanksgiving, you've got Christmas, and January was weak. And that's, of course, New Year's, everybody kind of getting ready for the new year. So we had these four straight months of very weak sales, and then you've had this pickup in retail sales. In February and March were much stronger than expected on the retail sales front. That's not really surprising because, again, as investors retrench, they still need to buy stuff from time to time. And so they kind of retrench as long as they can, and then they've got to kind of buy stuff, right? And so we kind of see these little bursts of activity in the economy. And that's what we've seen here as of late. And of course, we saw, February's Valentine's Day, big shopping day. And then March, which everybody was very excited about, was the strength of the retail sales in March. But that was also a combination of spring break and Easter all in one month. Easter got pulled forward, so into March, usually in April. So we had two big spending travel periods in the month of March that led to higher rate of retail sales. And of course, this gave kind of a boost to inflationary pressures as well. Oil prices have been on the rise because of kind of conflict overseas. So again, there's been kind of a good bit of short-term inputs into the inflation print. But sustainability, a lot of headlines talk about inflation's going to come roaring back. You have to talk about what's going to sustain that move higher in inflation. And some of the work you're working on right now doesn't really support that case. You want to explain?
Yeah. So the CPI inflation number is made up of a whole host of price data points, and like you said, some things get the headlines, like gas right now. But like used car prices have been down for a year and a half now. Remember when used car prices were driving inflation? Mm-hmm. So the point is there's a lot of give and take, and some inflation some prices are going up, some are going down. But at the end of the day, CPI is unfortunately about shelter prices. So almost 40% of CPI is in rents, or what they call imputed rents, which are just backing into what rents should be. And the problem we have is that when the BLS goes to look at the price of gas or bread or cars, they survey, they go to supermarkets, they survey car dealers. They want to know what a loaf of bread is trading for, what the new Tesla is trading for, the new Ford sells for. And from that, they know where it was last month, they know where it is now, and they can create the change. And it's based on the price of those goods in the latest month. Rent's a little different because you lock into a rent usually for a 1 year period. So, what the BLS does is surveys. They don't want to know, they don't care to know what rents are today. They just survey a bunch of people, and on average, they get their rents. But some people's rents were reset 10 months ago. Some were reset yesterday. So the person that was reset yesterday is probably the rent price. The person that was reset 11 months ago that's old news. And that's the problem with 40% of the CPI data. Now the Cleveland Fed puts out some rent indexes. One is the average rent and one is the new tenant rent. And this is pretty interesting. When you line them up, they tend to match each other very well. The average rent index lines up actually almost perfectly with the CPI rent index because it's taking an average. The new tenant rent index tends to lead both of those by about 9 months. Not surprisingly, when prices are going up, the new tenants are paying more than the average of the old tenants, and vice versa when they're coming down. So when you go and look at real market data from Redfin, from Apartment List, from a whole bunch of rental agencies, what you find is that rental prices are maybe slightly higher, but a lot of them have them actually declining, which runs in complete opposition to what both the Cleveland Fed's average rental index tells us and the BLS number tells us. But again, the Cleveland Fed has this new tenant rent index, which is falling like a rock. It's negative. I think it's 3 or 4%. And again, it tends to lead by 9 months. So we can kind of back into where the CPI shelter component is going. Doesn't mean we know where it's going to be in April, May, or June. But as we move out in time, we have more and more confident that the shelter number will follow as more and more people lock in new rents. It's going to follow it lower. So 40% of the number, not 2 or 3% that, everyone's talking about all these other things that are going up. They're small percentages. We're talking about 40% of the number is going to be heading down sharply. And I think that's one reason the Fed has been very, benign about inflation. They're not going to cut rates, but they're not even talking about raising the rates like we were talking about earlier. And I think because they know this, they understand the Cleveland Fed indexes and eventually the effect it'll have on inflation.
Yeah, that's right. And it's kind of interesting because, this is something that, again, kind of gets lost in the weeds. We talk about oil prices going up. That's inflationary. We talk about, food prices, et cetera. The problem is energy prices and transportation costs make up a very small percentage of the overall index. And this one big driver, which makes up 44% of the index, is coming down. And what's interesting is there's a massive overbuild of multifamily and rental units being done right now, which basic economics, supply and demand, when you have a oversupply of properties, which is coming to market right now, that's going to lead to lower prices in the future. It's just a function of time. All right, quick break. We're going to come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
It's very interesting right now. There's headlines on CNBC talking about Caitlin Clark, the female basketball player that just signed a contract with the WNBA for, don't quote me on the number, I think it was like $338,000 a year or something like that. Of course, everybody's up in arms now about how unfair the pay is between the NBA and the Women's National Basketball Association. And, they should be equal, right? I mean, Steph Curry makes $48 million a year. So why is Caitlin Clark only making $338,000 a year? It certainly seems unfair, right? I mean, they're both athletes. They're both bouncing basketballs and, shooting hoops, and they should be paid equally, right? But this is economics. And it's very interesting because this is how it works in, kind of all things in life. And these, and again, we were talking about headlines earlier, and this is a great headline for the moment. But this is economics at work. So let's just take a look real quick at a difference between the NBA and the WNBA, just as a moment, right? Revenue last year was over $10 billion for the NBA. The average salary is about $9.6 million. Total ticket prices run about $94 on average, right? In the WNBA, their total now this is revenue, and it was interesting because there was a LinkedIn post on this. Caitlin Clark's starting salary in the WNBA is whack. WNBA's revenue grew 233% in 2023 from $60 million in 2022 to $200 million in 2023. That's total revenue. That's not income. The WNBA lost money last year, and the NBA gave them the money to make up the difference. So the issue is always, these headlines make great headlines, but you have to dig down into the actual numbers. These are businesses. And again, there's a vast difference between $10 billion in revenue and $60 million, right? Because that's the revenue they have to pay these salaries out of. So let's just assume that we're going to pay the average salary in the NBA for a basketball player. This is average, right? $9.6 million. The average WNBA, $102,000. Now, that certainly seems very unfair. That's the equality between men and women clearly not there in terms of just looking at, if you were just looking at salaries, you say that's completely whack. That salary has to come from somewhere, right? We just don't make up numbers. If we were paying every female player in the WNBA $9.6 million a year on average, that would make it equivalent. We'd all be happy about that, but there's not enough money. The total revenue doesn't even cover the salary base, not including all the other operational costs and salaries and everything else that goes on inside of the WNBA, just like the NBA. There's just not the viewership for the WNBA that there is for the NBA, right? Average viewership in 2022 NBA Finals, 12.4 million. Average view for the finals of Women's National Basketball Association in 2022, 412,000. 12.4 million versus 412,000. And so this is what the headlines always get wrong when we get tied up into these social narratives, right? Everybody should be paid the same. Well, how many women, as an example, take the job of deep sea offshore welder in Northern Atlantic? Right, those guys make $500,000 to $1 million a year. Their life expectancy is like 3 years. Very tough work, but obviously, they get paid a lot for that. So, you always have to look. So when you hear these narratives about unequal pay between men and women, you have what a lot of these, articles and things don't do is compare specific jobs, saying this doctor and this doctor who are both neurosurgeons in the same hospital, what were their salaries? And so there's a disparity in that job. So that's pay inequality. When you have exactly the same job for the exact same experience, for the exact same, revenue that's created by that job, then you can say, yes, there's pay disparity. But you can't just in lump say there's a big gap between male and females in the medical profession because more females are basically in, doing nursing and administration, et cetera. And this part I'm just making up, but you understand what I'm saying, versus more men being doctors, right? Or surgeons, whatever it is, right? So you have to have equal comparison and look at the revenue that's generated, which is what pays the salaries, right? So I get everybody's upset. Caitlin Clark only got $338,000. She's now the highest paid female basketball player in the WNBA. Congrats for her. She's awesome. She's fantastic. She deserves every penny that she's getting paid. We just can't pay her $48 million like Stephen Curry, right? So this is the important thing about narratives, is just you've always got to look beyond the headlines. And this is the same thing with what's happening in the markets, or like Mike was talking about with inflation, et cetera. You've got to dig behind these headlines and look at the actual data of what's going on. So, Mike, you're nodding your head.
Yeah, no, I was actually thinking about hockey players. So if you bring it to men versus men, hockey players, the National Hockey League, they play virtually the same number of games as the NBA. Every game, 60 minutes. They travel the same amount. It's very comparable as far as effort and travel and everything involved, number of games. But a very good hockey player will make $4 or $5 million a year. The average NBA player is making, what'd you say, 9, 10 million?
Yeah. Why
is that fair? Well, it's fair because the NBA makes multiples of what the NHL makes. And it's like you said, I don't see anyone yelling because hockey players don't make what basketball players make. So, like you said, narratives are very important to understand. They're very important to either prove correct or not correct, but to understand where they're coming from and what they're doing.
Yeah, and again, this goes to a lot of this underlying economic narrative, and this has really kind of come across and again, this really kind of applies across all the economic data. Again, we were just talking about retail sales a second ago. We make these kind of assumptions about a headline numbers like, oh, retail sales were really strong in March, and they were. They were weaker, though, than they were in February. So what's that really telling you about spending? If we had both spring break and Easter in March, and your sales were weaker than the month of February, which had one extra day, right? Because it was leap year, but it only had Valentine's Day, which is a big day, right? I mean, we spend a lot of money on Valentine's Day. But again, you shouldn't a month of March have with two major events have more spending than in February if retail sales were as strong as everybody was saying they were? And again, this is why I'm saying you have to dig below these headlines to really kind of understand what's going on.
Right. The jobs market is similar, right? The headlines say we added 300,000 jobs. That's wonderful. Everything's great. But what kind of jobs? How are they? Are they good paying jobs, poor paying jobs, full-time, part-time? The number of full-time jobs has fallen by over 1 million in the last year, while part-time has risen. So yeah, there's more jobs. That's great, but there are lesser paying jobs. We know the industries that the jobs are coming from are the lowest paying industries. So, again, it's 300,000 jobs is wonderful. That's great. But the quality has a lot to be desired, just like the retail sales report, just like there's just a ton of diverging data that really leaves us, it can be very confusing. And the narrative kind of takes control of everything. Mm-hmm. But it's not usually the truth.
And speaking of employment, if you haven't had a chance, if you go to our website, realinvestmentadvice.com, and go to our Insights tab, and then under the blog section, I wrote an article last week specifically on employment, what Mike's talking about, and looking at immigration, which is impacting our employment data. And we've had 3.1 million immigrants that we know of right now, and those are being employed, and that's what's creating these stronger than expected employment numbers that are going on. We've had a big surge in part-time work versus a loss of full-time work. More foreign-born workers hired than native-born workers. In fact, there's a decline in native-born employment. And so when you actually take a look, again, below the headline of these strong employment numbers, full-time employment, which is what is needed to support economic activity, is falling sharply right now. So, full-time employment is being reduced, which will impact the economy and ultimately inflation later on this year. So, and again, I think, Mike, going back to Jerome Powell and a lot of things he's saying, Powell has to be looking at a lot of this data that certainly suggests that economic growth is slowing down, which will ultimately impact inflation.
Yeah. I think Powell's a little scared that this economy is not nearly as strong. And I think he knows that inflation will be coming down, but he can't do anything to get ahead of it because of the current narratives about inflation, about economic growth.
Right. He risks losing credibility if he starts cutting rates. And this has been my statement to you a couple of times, Mike. It's like, I don't understand why the Fed would cut rates here. Market's doing fine, economy's fine, employment's great. Why would you cut rates here? And I think, Jerome Powell has now kind of realized he's kind of in that trap, at least at the moment. So it'll be interesting to see how he works his way out of it. All right, Mike, thanks a lot. Appreciate it, as always. Be sure to by the website. Mike's article on the Bitcoin halving is on the website now. It's in our daily commentary. So if you're subscribed, you have already gotten it. It'll be delivered, or you will get it at 7:30 sharp this morning, Central Time. Also, as our latest market commentary update, etc. That's all in there. And then tomorrow, specifically talking a little bit about this inflation data that Mike was talking about. That'll be in tomorrow's daily commentary. So make sure you're subscribed to our daily market commentary. It comes out every morning at 7:30. Just go to the website, realinvestmentadvice.com. Also, like and subscribe to this channel. We appreciate it. We'll see you back here tomorrow for Financial Fitness Friday.